You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Hey, terrific. Before I introduce our panel, I did want to point something out. Jack had some great illustrations, and I think many of you were very interested in what he's doing. Just as a reminder, we're going to provide you all the slides from all the presentations today. That'll be provided to you electronically. If there's something specific or more information you want from one of the speakers, just reach out to anybody that's got this Swan badge on their lapel and give them a card. We'll make sure that you get what you need. One thing I did want to point out, he talked about sequence of return risk and the impact. And I think that's something that clients really don't understand. They just flat out don't get it. But the numbers don't lie. It's just math. So in your packages, just like this one here, not the brochure, but this package here, there's a brochure, and it's called the Retirement Multiplier Effect. Easier for me to say, multiplier. But it has a sequence of return example in there for you to use. And I think you can draw that back to pretty much anything we do with a defined risk strategy, regardless of the structure, regardless of the asset class, or what we're attempting to accomplish. So it's in there for your review, and if you want more information on it, again, just let us know. So Jack was good enough to share some information. He's also going to serve as our moderator for this panel, with his experience. And so I've invited Fred Wall from Brownlee Braden. He's from Dallas, Texas. He's been in this business for 40 years. He has an incredible background managing money of individuals, trust. He spent time at American Airlines on the pension plan. I got some time with him last night. And so just to have him up here to talk about this. He's a chief investment officer at Brownlee Braden and more than 40 years in the business. That's a long time.
Count, yes.
Yeah. And also Chris Breffard. Chris is with Prime Capital. I met Chris years ago when he was with a firm called the Mutual Fund Store in Kansas City. That went through an iteration of acquisitions of financial engines and Rick Edelman. And then next thing I know, I get a call from him, and he tells me he's over at Prime, and a firm that just in the last 6 years, 4 or 5 years actually, has grown from $2 billion to over $12 billion and 90 advisors with a national footprint. He's also the chief investment officer and managing director there as well of Wealth. And then we've got Paul Courtney from Springtide Partners. You'll notice he has a southern accent. It's actually a South African accent, but not quite like mine. But I met Paul a few years ago at a conference in Nashville and just having dinner, and I was intrigued by the way that he thought, his philosophy, his process, and approach. He was with a very large RIA firm here in Chicago for a number of years, he and his partner, and they've since branched off, started their own RIA. Was it 2 years ago?
2 years.
2 years ago, and now north of $4 billion in assets. And they do some pretty complex work, some pretty custom work for a set of very unique clients. So we've got three very different perspectives up here from the chief investment officer seat of these different firms. And I think coupled with what Jack's been able to bring to everyone today, it should make for an interesting conversation. And you've been a good audience about raising your hand and asking questions. This is great. So I just encourage you to continue to do so. Jack?
Great. Thank you. Well, great. So what I'd like to do is maybe start, Fred, with you, and we'll ask Chris and Paul to do the same thing. Is just maybe give us a little couple minutes on your background philosophy, what your firm does, and how you kind of attack the markets.
Sure. So Brownlee & Braden is a multifamily office, and we serve families with a holistic view of all financial affairs that they get involved in. So if you think of the chart that David Grau showed up this morning of all the services that we should be providing, we provide all those services to our clients throughout our relationship with them. And so it's always very interesting dealing with our families. When I think about my career, I basically summed this up last night. I was thinking about what I was going to say. So I've been criticized in my career for telling people how to build a clock when somebody asks me to tell the time. And, but I do that to show how some of the cogs fit into how I make decisions. So in the spirit of that, I'm going to give you a visual in the form of a postcard in the style of Carl Richards from Behavior Gap that basically says, volatility is returned, plus risk is managed, not avoided, over all models are wrong, but some are useful.
Great. Chris?
Sure. First, I'll start off with a quick correction. I am not CIO at Prime Capital. I'm going on 3 months there, but I'm managing director, and we have a CIO, Chris Osmond. We only allow people named Chris in our investment department. I was CIO at a firm called the Mutual Fund Store shortly after it was purchased by Warburg Pincus Private Equity in 2012. I came in 2013 as CIO. And then we were a hunted property. Warburg sold us to Financial Engines. We went public, and then we went private again late last year when Hellman Friedman Private Equity out of San Francisco, also majority holder of Edelman Financial Services, took us private again. And that was after those 3 transactions, and you had 3 different investment teams. That was the end of my run with that gig, but very happy to be with Prime Capital Investment Advisors. And Prime is actually relatively new name and brand. It was a 30-year firm known for most of that time as Long Financial, but 2 of the co-founders broke off and rebranded it Prime just over 2 years ago. And as Jamie indicated, we've gone through tremendous growth, went from actually just over $2 billion just before that to $12 billion now. And there's 3 main business units. I'm on the wealth management side, so Prime Capital Investment Advisors Wealth Management, but we also have a qualified plan advisors, QPA business, which is exactly as it sounds, qualified plans, about 400 to 500 small, mid-size qualified plans, and then recently just broke off Financial Fitness for Life, another business unit to do the educational component for qualified plans or for advisors that have qualified plans and don't have the time or resources or just want to outsource that. That's a brand new brand that we've broken out this year. So,
Great. Paul?
Yeah, so as Jamie was saying, we started Springtide about 2 years ago, a little more than 2 years ago, and we provide independent investment counsel to a range of RIAs, some very small breakaways. A common fact pattern is peeling away from a larger wirehouse or a bulge bracket firm. They lack the investment resources to sort of go it alone, and we support those firms, some larger RIAs, and then a couple of large family offices. And I would say our services at the low end is a little bit of everything. Model portfolios, helping a lot of our clients do stuff that they could do, they just don't have the time to. And as the clients get larger, we sort of fall more into the background and move more into a support role, and then sometimes helping key decision makers at firms either take a private deal over the finish line or approach alternatives of round out allocations. But it's a fluid offering on the low end. It's a little bit of everything, model portfolios, manager selection, and then as the clients get larger, typically turns into more bespoke engagements. And I'd say we probably fall in the sort of bootstrapped, scrappy startup camp. I think the number's a little bit misleading in terms of our AUA. And yeah, I mean, I don't think we do anything particularly complicated. I think a lot of it is, if you sort of really get down to it, it's fairly straightforward allocation decisions that our clients just don't have time to put weight behind.
Gotcha. All right, so let's kick it off. I want to tap these guys' brain power on the markets and see if we can get some insights. I think one of the things that we witnessed was a complete about-face by the Federal Reserve. I think they were trying to get some dry powder late last year when we realized that perhaps they realized either after Trump or on their own that there isn't much dry powder to be getting in this kind of marketplace. And so now they've reversed course. And And it sort of divided the investment camp to say, there's some that are celebrating the low interest rates. There are others that are worrying that this economy and market can't support higher interest rates. So I guess what I'll do is maybe start with you, Paul, and ask your view on where do you fall on this? Is it the glass half full, half empty, or somewhere in between?
Yeah, I think it's somewhere in between. I would comment that I do think it's a structural change. I think explicitly and implicitly the Fed has moved to, and this is via sort of moving to this equilibrium view of allowing inflation to drift higher than their previous target, which used to be viewed as a ceiling. Just language around their willingness to entertain another round of QE, their willingness to do some what would be considered, I think, crazy stuff with the Powell pre-October 2018 sort of narrative. I wasn't here for this morning's session, but I'm guessing Danielle sort of fully vetted this out. So I do think some of it's structural, and I think the way we're viewing it is potentially this is quote unquote extra innings of the cycle. But then I do also think that they're still reducing the balance sheet at roughly the same size. We still have a 9-hike sort of period in the rearview mirror with typically a 6 to 9 month lag before that stuff gets felt. You're starting to see on the margin very small little tick-ups in assessed interest at the consumer level, and just sort of a little bit of pain flowing through, a little bit of pain in some of the crappier tranches of corporate credit. And so part of me just thinks that this is just a normal cycle, and we're sort of over litigating what is just a classic end of a cycle.
Gotcha. Chris?
Well, certainly from an allocator perspective, it's made things even more difficult. The clientele we have is more mass affluent than high net worth, and it makes the message of, especially as we're now hitting another cycle of new all-time highs as a result of the Powell pivot and the complacency and liquidity that it provided. It does make it harder for anyone, I think, that is running any kind of a risk management operation. And our investment philosophy is centered around consistent risk-adjusted returns, diversification, and all of those messages get much more difficult with a mass affluent, more retail client-oriented base. So it certainly makes the results in financials look a lot better with all-time highs, especially coming up right as we went into a quarter-end cycle and billing cycle. But the conversations for our advisors get much more difficult, and certainly from a risk manager perspective, it makes it much more trickier. For all the reasons we heard in some of the sessions earlier today, including a lot of the observations Danielle made in terms of the compressed volatility we're seeing. That's again gone way beyond what we saw in the beginning of the 2018 blow up. But at the same time, you have clients saying new all-time highs. Look what the S&P 500 is doing, and why am I not participating in that? So, the education communication gets much more difficult.
Gotcha. Fred?
So for me, I think it's business as usual in terms of the Fed and valuation. They've kept interest rates so low for so long that people are struggling, and we've talked about this already in this conference, struggling to get income and to diversify portfolios. So the reason I say it's business as usual is I run this model that basically values the S&P at a quarterly basis. And I compare it to what's going on in the economy, what's going on with interest rates and corporate fundamentals. And so looking at March of 2019, a couple things have happened. We're at extremely high return on equity on the S&P 500, about 18% on a 12-month run basis, which is, to me, a function of the tax cuts the corporations got, which I don't think are going to last forever. And the implied return of the S&P is about 8.5%, which has been, it was like that before the fourth quarter decline, and it just has stabilized at that level. Part of that metric I back into a risk-adjusted implied 10-year corporate bond rate, and it's been consistently in the mid-4s for the last 15 years. And so the stock market, in my opinion, has been discounting normalized interest rates. And so what happened in the fourth quarter, and with the perspective of Danielle's comments this morning, we went above that level in corporate bond rates in the fourth quarter for systemic reasons, which she described. So in hindsight, it's all perfectly clear to me why that happened. But you know, my forecast for this year, based on the fundamentals, it's not a forecast, it's just the numbers, was 20%, and we basically were 3% below that at the end of Friday of last week. Volatility went as low as 12.5%. It closed at 13 on Friday, and I think that's the lower threshold. Stake in the ground that I would watch in terms of portfolio risk is 17%. If you go back and look at volatility and how it changed going into the volatility spikes in January, February last year, and the fourth quarter, 15% was sort of the threshold. It got there, sort of wiggled around, and then shot higher in the volatility spikes. So there's a couple stakes in the ground. In terms of asset allocation, we've been allocating away from long equity into covered call strategies since the fall of 2017. And so all new deployments are going into covered call strategies in the large cap space. We don't do a lot of fixed income, which is kind of ironic. We do a lot of private equity. The way we've changed that is we're tilting more toward private equity structures that throw off consistent income in the 6 to 7% range and still give us high mid-teen total returns over the 7 to 10 year life of the investments. And so that's the biggest thing. And I'm not throwing this out as something that I suggest that you do, but the other thing we're doing to take advantage of the anomaly in the interest rates across the world is we're actually borrowing money in euro, paying 75 basis points, which Draghi has guaranteed us that we're going to enjoy that until next year sometime. And we're reinvesting the proceeds of those loans into short-term corporate bonds for about a 2.3% spread. The currency offset is in our international exposure. It's not a one-for-one, but since we take a total portfolio perspective, we treat that like any other asset in our portfolio. So if we have losses on the currency, we use that to offset gains in the rest of the portfolio and vice versa. Right now, we have pretty significant profits in that currency, and we've had some clients that are actually taking those profits and offsetting them against some losses that they took to rebalance.
Gotcha. Okay, Chris, I'm going to start with you on this one. It's a two-part question. One is, I'm a baseball fan. What inning are we in on a cycle, business cycle basis? And if you felt that we were heading to a downturn, would you use tactical strategies to reduce your risk?
Well, it certainly feels, and a lot of the metrics support that we're in those late innings of 7, 8. But are we going to get a game like last night where we go 14 or 15 innings? And it certainly seems that's a realistic probability. And what do you do to plan for that? What is the tactical and risk management play on that? And that's where it gets extremely difficult, especially when you start to consider the valuations across asset classes and the difficulty in finding diversification across and within asset classes. But as part of those tactical plays, we heard a little bit about it in some of the earlier sessions again, looking for some opportunities outside of the public markets. We do have a covered call strategy. We have some alternative strategies in looking at private equity, in some of those thematic plays. Software as a service is one that's done really well. So just trying to find differentiators or just better risk-return trade-offs than the standard core plain vanilla asset classes, which just don't look tremendously compelling right now.
Gotcha. Fred? Take that.
I'm sorry, what's the question?
So the question is, what inning are we in, and would you use tactical strategies to get out of the way of the downturn?
Until I heard Daniel this morning, I thought we were in the 8th or 9th inning. I told her when I went to get her to sign my book that I have to rethink the probabilities of that 20% upside that I talked about earlier. So the environment we're in now reminds me of this 2000 and the Y2K dot-com bubble. I had a meeting with one of my clients in the spring of 2000, and he asked me a question which I had never really thought about, even though I think of things in terms of probabilities. He asked me what I thought the probability of a 20% upside was at that point in time, and I told him I thought it was about 5%. And he said, okay. So we did a lot of restructuring around that. There was a reason he was asking me that, which I won't go into. But so what we're dealing with now reminds me of that. And based on what she said, that we could have more upside in the stock market, we meet with our clients quarterly, and we actually have the managers come in and talk to our clients as well. They provide us a deck about 2 days before the meeting, and I don't generally get to go through it before the meeting in great detail. But it happened to come across a slide where a manager had a picture in there that showed their best case scenario was 18% up this year with a 25% probability. Their expected return was 9% with a 55% probability, and the downside was 18% with a 20% probability. So the first thing I'll say about that is it's a negatively skewed distribution. But being a math geek, I basically calculated what the standard deviation that was implied by that distribution was 13%. And the downside deviation was 17%, which is how I got the numbers I told you about before. So for that manager, we've already made this 18% upside. Mm-hmm. So from my point of view, I need to go back to look at that distribution and figure out what the odds are of another 20% upside, and whether there's any probability we're going to get the 9% in the expected return. So to me, it's going to be a lopsided asymmetric distribution with more upside, but also more downside and more negative skew. So right now, my expected return for the S&P is 0, with about a 25% volatility on both sides.
Okay, so I take it you're using tactical strategies to get out of the way. You're the only person I know that actually did compare this market to Y2K. I did too, because remember, Alan Greenspan was reading Ed Yardeni's work. Remember, Ed Yardeni was saying how we wouldn't be able to turn the lights on after the turn of the year, turn of the millennium. And so Greenspan kept interest rates artificially low, below fair value, going into Y2K. And of course, we had large cap tech stocks leading the way, right, and all of a lot of similarities, to the Y2K experience. Paul, you want to take the? Yeah,
I would say I do strongly believe that the correct answer is none of us have a clue what's going to happen and sort of where we are. And so with that caveat, we'll still give it a red hot go. I think the most important thing is sort of the clients you're optimizing for, and for people working with ultra high net worth individuals or family offices that have the benefit of time and are not tethered to a very visible Dow or S&P 500. I think it doesn't really matter, right? You're sort of playing the long game, and your allocations are immunized. Jack, to use your word from earlier. I think where it becomes really challenging is younger clients, smaller pools of capital, and people that have recently broken away, or where clients are sort of experiencing the first couple of years of an engagement, or just anything like that, where the short term does become far more important. And I think I don't know of a model that has any sort of correlation with short-term returns. I just don't. I mean, we've spent a lot of time looking. I don't know if there's any way to do it. we do have inputs that give us a fairly good idea of what the longer term looks like. Sort of 5, 7, 10 years is even better. And it's going to be rough for the next 10 years, given starting yields and valuations. And the inputs to any sort of good capital market expectations over 10 years. On the bond side, it's math, right? You get 2.55 or 2.6, whatever the 10 years at. You get 26, 27 basis points for IG credit over that. And then on the equity side, whatever, long-term earnings growth is 6+%, throw in a dividend yield, and then your mean reversion factor is how you go from, on the low end, the Granthams and the AQRs and the mean reversion guys who are somewhere between 0 and 2 on the equity side, maybe 0 and 3. And then the more of the CAPM-based building blocks, you get closer to like 6, maybe 7. And you combine those two together, and it doesn't look great. And so I bring that up because as we think about tactical allocations, so sort of a little sidebar comment, 10-year returns are no longer long-term. The point of long-term returns is to smooth out the cyclicality of returns, and 10-year is now anniversarying the depths of the crisis, right? So 10-year returns in the S&P 500 are like 16%. 10-year returns on a balanced portfolio, 12 or 11, somewhere between 11 and 12. I think we have to spend as much time as possible de-anchoring clients from that, and throw 20-year return numbers in charts if you can, or in performance reports. The 20-year number for large cap stocks, because it's more of an apples to apples to comparison, late cycle to late cycle, it's like 6.5%. Anyway, I bring all of that up because I think the opportunity cost of taking money from long-only core assets and deploying it in either hedged strategies if you need to be fully invested, cash or short duration bonds if you have the benefit of having those in portfolios, or just anything else. I mean, I obviously have some views on that. We do some opportunistic credit. We do some stuff with tactical closed-end funds. We do a little bit on value-based long-short equity. There's a host of things. I'm not excited about anything. I mean, I think, I just realistically, I just think it's, to me, the pain trade is like a death by 1,000 cuts over 10 years.
Yeah. All right, so we've had this, switching gears a little, we've had this tsunami of capital coming into passive, ETF, generally cap-weighted strategies. And of course, as we've seen, it's left value investing in the dust. It's left smaller cap investing, which has historically outperformed large, pretty much in the dust. I guess my question is, do you see that trend continuing? And Fred, we'll start with you. Do you see that trend continuing, and how would you anticipate, or not, and how would you perhaps see how the markets behave as a result of that?
So I don't think the trend's going to continue. It'll continue for a while because that's just what people are acclimated to right now. One of my biggest concerns is the liquidity that disappears when everybody goes for the exits in the ETFs. We don't recommend passive strategies to our clients. We're totally active in everything that we do, which is kind of different than what most people are doing. And the reason we do that is we give up something on the upside because all of our active managers lag. They have about an 80% capture on the upside. But where they add value is on the downside. In the fourth quarter of last year, our active managers were down between 5 and 8%, with the market down almost 20. And they came back before the market went to 17% last week. They were at break even and above where they were in September by mid-February. And so I think that that's what I expect them to do, and that's what they did. There's nothing wrong with passive, but people have to educate their clients that they're going to experience all the downside that there is. And I like Paul's comments. The only way you can deal with a market where you have sub-average returns is to reduce your risk somehow. You can do that actively by just bringing in your beta or your average volatility. For us, we have one benchmark. It's the endowment model. The average annual volatility is about 12%, and right now I'm steering portfolios to be between 7 and 8% volatile, either through hedging or just allocating to get more cash flow or whatever. But that's the only way you can control in a low interest rate environment is to reduce your risk exposure. And I think anybody can do that.
Yeah. Paul, do you want to tackle the passive trend?
No, I think I would echo a lot of what Frank said as well. We try to be totally agnostic between active and passive. We approach every asset class, and if active makes sense, it should show up in the evidence. There should be a high percentage of managers that have added value relative to the benchmark over the long term. And then what we try to do is we try to buy those managers when they look unattractive, when they're trailing the benchmark over 3, 4, or 5 years. There's not a lot of asset classes where that's the case, but I do think, especially if you take a sort of contrarian view of value relative to growth and momentum, that I think there's a lot of great value shops out there that should be able to do really well. And for historical analogs, I think the late 98 Greenspan panic about weakness in EM, cutting rates 3 times intra-meeting, and then the sort of 99 spaz up was, I think that's probably an okay analog. Mm-hmm. And even in that world, you struggle for a year and then you make it all back and then some. Value managers obviously crushed it in late 2000, 2001, 2002. So I think if anything, I would say we would let the pendulum swing more to active and probably to value as well. Totally would echo what Frank said.
Chris?
Somehow you managed to find the last 3 advocates of active management in one stage. So if you think about the firm I came from, the mutual fund store, the stigma and term mutual fund, let alone 100% active mutual fund, which it was when I first arrived 6 years ago. We did add passive, but we were still about 75 active when I walked out the door. We're not dogmatic about active passive, but with a process all oriented around consistent risk-adjusted return. We still use a lot of active managers and have that shared philosophy with the current firm I'm with, Prime Capital. So we are using active. We're probably about 2/3 active in the current portfolios at Prime, and getting more active because of a lot of this things we've already heard. Just looking for the downside mitigation and looking to mitigate the drawdowns. Particularly in areas, we heard the term zombie companies. I don't want to be in a Russell 2000 strategy when they're nearing 40% negative earners. Yes, maybe we did get a reset on rates for a little while, but I don't want to have 40% non-earners when interest rates are going out and liquidity starts to dry up. So that's an area. Even though it's a deep liquid pool, U.S. public companies, that's an area where we're happy to give up a little cost to get the downside mitigation of an active manager. Same thing in some areas like emerging markets and international. So that's basically what we're looking at and trying to evaluate and assess the risk-return trade-offs and the profiles of strategies. Rather than just be, absolute, active or passive, and bet everything red or black.
Well, great. Well, thank you. We have a few minutes left, and I want to make sure we're able to address any questions that you have for our panelists.
We didn't get enough coffee outside.
Okay. Otherwise, I got more questions. You're going to hear mine? Oh, God forbid. All right. Yeah. Go ahead.
Inflation has been somewhat non-existent, but one of my concerns in dealing with my clients is maintaining the purchasing power of their assets, because if the central bankers have their way, they're going to crush those people. So how are you addressing that risk in the management of your portfolios?
Do you want me to go first?
Yeah, go ahead.
So part of reducing risk is holding higher cash balances, and for now you're getting a real return investing in short-term treasuries over inflation. To your point, I'm not sure, in the long run, if everything blows up and the dollar gets weaker, that we're not going to have inflation. So I'm not sure how much that should last. At this stage of the cycle, we should be probably 1.5% to 2% above inflation on short-term rates if the Fed's doing their job correctly, and we're not anywhere close to that. So there's not really a cushion for for inflation premium, if you will. But for 10 years, savers have been starved for yield, and so on top of the demographics that suggest that interest rates will stay low because people are getting older in the world, I think every time you get a pop-up in yield, people are going to just go in and drive yields back down, and that could last for a couple of years. Because they're not really looking at real returns. My wife is one of those people. She wants everything under the mattress, and she doesn't understand that she's losing money to inflation, even at low interest rates or low inflation rates. So I think it's going to evolve over time. I will say that probably 5 years ago, everybody was sure that inflation was going to rear its ugly head, and it hasn't. And so we've already been burned once. So, the behavioral bias is that, I'm not going to go there again. So it's going to take a while. You'll have to go higher, and we'll have to get more evidence of negative real returns again before people realize what's going on there. But that's all part and parcel of reducing portfolio risk on average.
Earlier, we had a question. It looks like Joe might have left, but he mentioned Lacey Hunt has been saying, it's not a household name. I don't know who knows who Lacey Hunt is. Works for a firm called Hoisington Asset Management. And in 2010, I was at the CFA annual conference in Boston and at a session hosted by Van Hoisington. And Van asked a room a little bigger than this room, who thinks inflation is going to be a problem? Almost all the hands, including mine, went up. Who thinks it's going to be a runaway problem? Same thing, almost. And then he proceeded to tell us why we were wrong for the next 50 minutes or so. And it was eye-opening, and it was one of those mental checks where you say, okay, here's a manager. He only does one thing. He manages government securities. There's only one thing he has to get right. What is inflation going to do? And he was absolutely convicted that inflation wasn't going to be a problem for years to come, and totally contrary to conventional wisdom at that time, in the middle of QE3, I think, at that point. But it's been a challenge ever since, because anytime you have a tick up in any one of the the inflation measures, it's like 2008 redux is around the corner, or massive inflation, one or the other. Some kind of extreme is going to happen. But we generally have to go back to the challenging aspects I alluded to earlier of just constant education with the clients that we have to take risk in certain asset classes to get real returns, and real returns that are materially above cash, even when there's no inflation, just to hit your goals for the whole goals-based planning approach. So it's a challenge, but it's nice to see that we are finally getting some savers, some relatively decent yields, but certainly nothing that is going to be real attractive for those longer term aspirational goals. So you still need to find spots and be tactical in the other asset classes to make up for the inflation environment and getting real returns in an era where there's not a whole lot of forecasted real return in many asset classes.
Great. I
Just wait, one comment I was just
yeah,
gonna
why
make.
don't you wrap it up, Chris, because I think we've got
Okay.
just about a minute to go.
I was just going to say, so a guy named Eric Townsend runs a blog called Macro Voices, and he recently, I want to say within the last 2 weeks, did an interview with Lacey Hunt where they talk about, and Hunt's thesis is basically just that massive amounts of debt, the servicing of that debt funnels money away from productive sources. You get it. Anyway, the one thing that I do think is worth paying attention to is as the political pendulum swings and potentially swings really far, whether or not it's this year or 2024, next year or 2024, is just keeping track of modern monetary theory and this sort of notion. Now, he does make a really cogent case that you'll have a lead time, right? Like it is currently illegal for them to directly monetize debt. They can do it through the balance sheet, but that doesn't transmit to the streets. But that's where I spend my time, sort of worrying about that on the political side. And I mean, with $10 trillion of negative yielding debt, you can buy that really useless, unproductive gold asset, and it's got a high yield and a crap ton of sovereign bonds out there.
I was just going to mention being back in the 10 trillion mark for negative yielding debt. Plus you look at all the education around, in demographics. It's hard to make a case for any kind of surging inflation. So there's a number of other arguments that go along with some of the points Lacey and others are making.
Well, great. Well, that wraps it up. Let's hear it for our panelists. Thank you. Great comments. Jamie, I guess I'll toss it back to you.
Thank you. Gentlemen, thank you once again. A terrific job. Thank you for sharing your time with us out of your day and of course, contributing your wisdom and your thoughts of what's going on in this marketplace. So thank you so much. Jack, thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.